Somewhere in America, right now, a 72-year-old widow named Eleanor is sitting at her kitchen table, sorting through a stack of bills. Same envelopes, same amounts, same routine she's had for the last 30 years. She pays them because she always has. She pays them because she thinks she has to. But here's the part nobody ever told her. At least one of those bills, maybe two, maybe three, she legally stopped owing the day she turned 65. Not reduced, not discounted, legally exempt, waived, or protected under a rule that quietly changed for her 7 years ago. And in those 7 years, no one from the county, no one from the state, no one from the federal government ever picked up the phone to tell her. Because that's not how this system works. When you turn 65 in the United States, something strange happens. On paper, you unlock a series of legal protections, tax breaks, and exemptions that were designed specifically for you. Programs written into federal law, rules on the books in almost every state, waivers your bank, your utility company, and your county tax office are aware of. But the burden of knowing, the burden of asking, the burden of filing the right form sits entirely on your shoulders. Nobody sends a letter, nobody makes a call, nobody knocks on your door. The money just keeps leaving your account. And when you add it all up across a year, the number is bigger than most people realize. Depending on your state, your income, and which bills you're still paying without asking questions, the average American senior is quietly overpaying somewhere between $1,800 and $6,000 a year on bills they could legally reduce, waive, or in some cases, stop paying altogether. That's not a typo. That's not exaggeration. That's real money. Money that could be groceries, medication, a grandchild's birthday, a small cushion in the bank, sitting in someone else's pocket because a form never got filed. In this video, I'm going to walk you through 5 specific bills that seniors over 65 are still paying, that in many cases they are no longer legally required to pay in full, or in some cases, at all. I've ranked them from the smallest surprise to the biggest money leak, and I'll tell you right now, number 5 is the one that costs seniors the most, and it's also the one almost nobody talks about. Before we get into it, one honest note. Rules vary by state, they vary by county, they vary by income level and by year. So when I give you a number or a program name, I'm going to be careful. I'll tell you what applies federally, what usually applies at the state level, and what you'll need to confirm locally. Because the goal here is not to hype you up. The goal is to hand you something you can actually use, a phone call you can actually make, a form you can actually ask for, and a bill you can actually stop paying. So let's start with the one that costs seniors more silently than any other. It shows up once or twice a year. Most people just pay it without reading it. And in most states, if you're over 65, you're leaving hundreds, sometimes thousands of dollars on the table every single time it arrives in the mail. Let's talk about your property tax bill. Here's the quiet truth about property taxes in America. If you own a home and you're over 65, there is almost certainly a program in your state designed to lower that bill. Sometimes it freezes the bill so it can never go up again. Sometimes it exempts a portion of your home's value from being taxed at all. Sometimes it defers the tax entirely until the house is sold. And in a handful of states, if you meet the income limits, it can wipe the bill down to almost nothing. But almost none of it happens automatically. That's the trap. That's the whole trap in one sentence. The exemption exists. The law is on the books. The county knows about it. And unless you walk into that county office or call that county office and ask for it by name, they will keep sending you the full bill, year after year, and you will keep paying it. Take Texas, for example. A homeowner over 65 qualifies for an additional homestead exemption on top of the regular one, plus a school district tax ceiling that freezes the school portion of the bill at the amount it was the year they turned 65. That freeze alone, over 10 or 15 years of rising property values, can save a senior tens of thousands of dollars. But you have to apply. The county appraisal district doesn't call you on your birthday. In Florida, seniors who meet the income limits can qualify for an additional homestead exemption of up to $50,000 off their home's assessed value, on top of the standard exemption. In some counties, if you've lived in the home long enough, that number goes even higher. Same story. You have to file. In New York, there's a program called the Enhanced Star Exemption for homeowners 65 and older. In Pennsylvania, there's the property tax and rent rebate. In Illinois, there's the senior citizens homestead exemption and a separate senior freeze. In New Jersey, Georgia, Ohio, Michigan, Arizona, Oregon, the list keeps going. Nearly every state has something. And in most of those states, seniors are eligible and never file. Now here's where it starts getting expensive. Imagine a retired couple in Ohio. Their property tax bill is around $4,200 a year. They've been paying it out of a joint checking account fed by 2 Social Security checks and a small pension. Between the state's homestead exemption for seniors and a local reduction they qualify for based on income, that bill could legally be closer to $2,800. That's $1,400 a year, every year, for as long as they own the home. In 10 years, that's $14,000 sitting on a form they never filed. And here's the part that stings the most. If a senior qualifies for the exemption in a given year and misses the deadline, most states do not go back and refund the difference. The money is simply gone. You start saving from the year you file, not from the year you became eligible. So the mistake most people make is assuming this doesn't apply to them. They assume they make too much. They assume the house is too big. They assume they would have been told. None of those assumptions are safe. The income limits in some states are surprisingly high. The exemptions in some counties apply regardless of income, and nobody was ever going to tell you. Here's your practical move. Pick up the phone. Call your county assessor's office, sometimes listed as the county appraiser or the property tax office. Say these exact words. I am over 65. I want to know every senior exemption, freeze, deferral, and rebate I may qualify for on my property taxes, and I want to know the deadlines to file. Then write down every program they name, ask for the forms, ask what documents you need to bring, and file. Do that one phone call this week, and you may have already justified the next 20 minutes of this video. But if the county is quiet about your property taxes, wait until you hear what the hospitals and clinics are quietly doing with your medical bills. There is a very specific kind of envelope that seniors in this country have learned to dread. It shows up a few weeks after a doctor's visit, or a lab test, or a hospital stay. The letterhead looks official, the amount looks final, and down at the bottom, in bold, there's a due date. Most people just pay it. But here's what most seniors never hear. A meaningful portion of the medical bills sent to Americans over 65 are not legally collectible in the amount printed on the page. Some of them shouldn't have been sent at all, and in certain cases, paying the bill in full is actually a mistake, because once you pay it, getting that money back becomes a fight. Let me explain what's really going on. If you're on Medicare and your provider accepts Medicare, which the vast majority do, there are strict federal rules about what they are allowed to charge you. Medicare sets an approved amount for the service. Medicare pays its share. You are responsible for your deductible, your co-insurance, and your copay. That's it. If the provider tries to bill you for the difference between their sticker price and what Medicare approved, that's called balance billing. And for participating providers, it is not allowed under federal law. But it happens anyway. It happens all the time. Not because hospitals are all trying to cheat seniors, but because billing departments are enormous, automated, and full of errors. And they assume, quite reasonably, that most people will just pay whatever the envelope says. Then there's the No Surprises Act. This is a federal law that took effect in 2022, and it protects patients, including seniors, from certain kinds of surprise bills. If you went to an in-network hospital and got treated by an out-of-network anesthesiologist or radiologist you never met, never chose, and never signed a waiver for, that surprise bill is restricted under federal law. If you had an emergency and were taken to an out-of-network facility, you're protected there too. The bill you're holding may not be enforceable in the amount it shows. And then there's the biggest one, Medicaid. Many seniors on a fixed income qualify for what's called a Medicare savings program, or in some cases full Medicaid, without realizing it. When you're a dual eligible, meaning you have both Medicare and Medicaid, federal law prohibits providers from billing you for Medicare cost sharing. The copay isn't yours. The coinsurance isn't yours. Medicaid is supposed to cover it, or the provider is supposed to write it off. Either way, you don't owe it. Now here's where it gets uncomfortable. There are seniors right now, on Social Security, paying medical bills out of pocket every month, who are technically dual eligible and don't know it. Every one of those payments is money they were never legally required to hand over. Picture Raymond, a 78-year-old retiree living on about $1,700 a month from Social Security. He's been paying roughly $140 a month in medical copays and coinsurance. He assumes it's just the cost of being old. But based on his income, he likely qualifies for the Qualified Medicare Beneficiary Program. If he applied and got approved, those bills stop. Not reduce, stop. That's about $1,700 a year in his pocket for the rest of his life. Here's your practical move. Never pay a medical bill the day it arrives. First, ask for an itemized statement, not the summary, the itemized one with billing codes. Second, compare it to your Medicare summary notice or your online Medicare account. Third, if the numbers don't match, call the provider's billing department and ask them to explain the charge in light of Medicare's approved amount. Fourth, if you're on a limited income, call your state Medicaid office and ask if you qualify for a Medicare savings program. Do those 4 things, and a real portion of those envelopes stop mattering. But if the hospitals quietly overcharge, wait until you see what the phone, internet, and utility companies get away with. Look at your phone bill. Look at your internet bill. Look at what you paid last month to keep the lights on and the heat running. Now understand this, for millions of Americans over 65, a large chunk of what's on those bills is optional. Not because you can cancel the service, you still need the phone, you still need the heat, but because there are federal and state programs specifically designed to pay part of those bills for you. Programs written into law. Programs funded and running right now. Programs that require nothing from you except an application. And most seniors have never heard their names. Let's start with the phone and the internet. There is a federal program called Lifeline. It's been around for decades. It provides a monthly discount on phone or internet service for households that meet certain income limits, or for anyone already enrolled in programs like Medicaid, SNAP, SSI, or Veterans Pension. The discount is not huge on paper, but for a senior on a fixed income, it's real money every month, and it stacks with other savings. Then there's the Affordable Connectivity Program's history. That specific program has faced funding uncertainty, so before you count on it, verify what's currently available. But the broader point still matters. There are ongoing federal and state-level programs, and many phone and internet companies have their own low-income and senior discount plans that they do not advertise loudly. If you call your carrier and ask, plainly, what senior or low-income discount plans do you offer, and do I qualify, you will often be surprised by the answer. Now let's talk about the utility bill. This is where it gets more expensive. There's a federal program called LIHEAP, the Low Income Home Energy Assistance Program. It helps pay heating bills in the winter, and in many states, cooling bills in the summer. It's administered through the states, so the exact eligibility varies, but seniors are often prioritized. In some states, LIHEAP can pay several $100s a year toward your energy bill. In a bad winter, it can pay more. On top of LIHEAP, most states have their own utility assistance programs. Some have a percentage of income payment plan, which caps your utility bill at a small percentage of your monthly income. Some have senior-specific discount rates that utilities are required to offer. Some have shut-off protections that make it illegal for a utility to disconnect a household with a senior during certain months of the year. You will almost never hear about these programs from the utility company on its own. The bill will arrive, the amount will be the amount, and if you pay it, they will assume you're fine. Picture Carol, a 68-year-old widow in Pennsylvania. Her electric bill in July runs close to $200 because she keeps the air conditioning on to manage her blood pressure. She's on Social Security. She qualifies, based on her income, for both LIHEAP and her state's utility discount program. Between the two, she could be saving something in the range of $40 to $80 a month, depending on the season. Over a year, that's real grocery money. Over 10 years, it's a used car. Here's your practical move. 3 phone calls. 1 to your phone or internet carrier. Ask about Lifeline and any senior or low-income plan. 1 to your gas or electric utility. Ask about LIHEAP. Ask about their senior discount. Ask about their percentage of income plan. Ask about winter and summer shutoff protections. And 1 to your state's Department of Human Services or Area Agency on Aging. They keep the list of every energy and utility assistance program in your state and can walk you through what you qualify for. 3 calls, maybe an hour of your afternoon, and in many cases, hundreds of dollars a year that stop leaving your account. But this next one is different. because the next bill we're going to talk about isn't coming from a utility or a hospital or a county office. It's coming from your own bank. Let's pause for a second. If you've made it this far, you already know more than most people your age walking into a county office or a bank branch this week. You've heard 4 programs, at least 3 phone calls to make, and a handful of forms worth asking about by name. Now here's the one that surprises people the most, because it doesn't come from the government, it doesn't come from a hospital, it comes from the place you probably trust more than any of them, your bank. Sit down with a bank statement. Any month will do. Look at the line items: monthly maintenance fee, overdraft fee, paper statement fee, a TM fee, minimum balance fee, wire fee, inactivity fee. For a lot of seniors, those little charges are just background noise. $5 here, $12 there, $35 if something bounced. It doesn't feel like much until you add up a year. And here's where it starts getting expensive. Many major banks in this country offer senior checking accounts specifically designed for customers over a certain age, usually 62 or 65, that waive the monthly fee, waive the minimum balance, offer free checks, and reduce or eliminate certain other charges. These accounts exist right now at some of the largest banks in America. They are not secret. They are just not offered to you unless you ask. The trap is that if you've had the same checking account for 30 years, your bank is not going to call you on your birthday and move you into the senior version. You will keep paying the maintenance fee. You will keep paying the paper statement fee. You will keep paying whatever your old account terms said, even after you became eligible for a better one. Now here's the part almost nobody talks about. Federal law provides special protection for Social Security money in your bank account. When your Social Security check is directly deposited, that money is generally protected from garnishment by most creditors. If a debt collector gets a judgment and tries to freeze your account, the bank is required, under federal rules, to review the last 2 months of deposits and protect the Social Security funds up to a certain amount. That protection is automatic, but only for direct deposits, and only if the bank can identify the deposits as federal benefits. Which means 2 things. First, if you're still getting a paper Social Security check and cashing it, you're losing that automatic protection. Switching to direct deposit is not just a convenience, it's a legal shield. Second, if your account ever does get frozen or garnished, you have the right to challenge it and claim the exempt funds. The bank will not always walk you through that process on its own. And then there are overdraft fees. Federal regulators have spent the last few years pushing banks to reduce or eliminate overdraft fees, and many banks have. Some have capped them. Some have eliminated them on small transactions. Some have introduced grace periods. But if you're on an older account, you may still be getting hit with the old fee structure. $35 for a $5 overdraft, because nobody moved you to the newer terms. Picture Tom, 74, on Social Security and a small pension. He gets hit with 2 overdraft fees in a bad month, $70, plus a $15 monthly maintenance fee, plus a $3 paper statement fee. That's $88 in 1 month. Over a year and a few rough months, he can easily lose $300 or $400 to fees that his bank quietly offers a way out of. Here's your practical move. Walk into your bank branch or call the customer service number on the back of your card. Say this: I am over 65. I want to be moved into your senior or no-fee checking account. I want overdraft fees waived or reduced if that option exists. I want my Social Security direct deposit confirmed and flagged as a federal benefit. And I want a list of every fee currently being charged on this account. Ask those questions plainly. Write down the answers. If the bank refuses to move you into a better account, that's information too. And there are credit unions and community banks in almost every town that will. But the biggest one is still ahead. It's the bill most seniors keep paying every single year, without ever asking whether they legally owe it. And that bill comes from the IRS. This is the big one. Not because the IRS is coming after seniors. It isn't. But because every year, millions of Americans over 65 either file a tax return they didn't have to file, or pay federal income tax they didn't legally owe, or both. And the numbers involved are not small. For some households, we're talking about hundreds. For others, we're talking about thousands, every single year. Let's walk through what actually changes at 65. First, the standard deduction. If you're 65 or older, the IRS gives you an additional standard deduction on top of the regular one. This is not a credit you have to fight for. This is not a form you have to hunt down. It is built into the tax code. But it only helps you if you know it's there, and if the person or software preparing your return is applying it correctly. If you file your own return and check the wrong box, or miss the box entirely, you lose it. If you use a preparer who's rushing, it can get missed. And every dollar of that extra deduction is a dollar the IRS is not allowed to tax. Second, the filing threshold. For seniors, the income level at which you are required to file a federal return is higher than it is for younger taxpayers. That means many seniors on modest Social Security and a small pension or IRA withdrawal are below the threshold and technically do not have to file at all. They file anyway, out of habit, sometimes paying a preparer to do it, sometimes paying tax that a correct calculation would have shown they didn't owe. Third, and this is the one that catches the most people, Social Security is not automatically taxable. There's a formula. It depends on your combined income, which is your adjusted gross income plus tax-exempt interest plus half of your Social Security benefits. If that number is below a certain threshold, none of your Social Security is taxed. If it's in the middle range, up to half is taxable. If it's above the top range, up to 85% is taxable. But if your income is genuinely modest, your Social Security may not be taxable at all. Many seniors don't run the math and just assume it is. Fourth, there's the credit for the elderly or the disabled. This is a specific federal credit for taxpayers 65 or older who fall under certain income limits. It's not huge for everyone who qualifies, but it exists, it's real, and most people who could take it never do, because they never heard of it, and their preparer never brought it up. Fifth, on the state side, many states either don't tax Social Security at all, or exempt a portion of retirement income for seniors, or provide senior-specific credits. Rules vary widely, and the exact numbers should be verified locally, but the broader point still matters. Your state tax bill after 65 may look very different from your federal one, and both may be lower than you assumed. Now here's where it gets expensive. Picture Linda and David, both 70, filing jointly. Combined income around $48,000 a year, Social Security, a small pension, a modest IRA withdrawal. They've been filing the same way for a decade, using the same online software, checking the same boxes their younger neighbor uses. But they've been missing the full additional standard deduction for age. They've been over-reporting the taxable portion of their Social Security, and they've never claimed the credit for the elderly, even though they qualify some years. Between those three things, they may be overpaying federal tax by anywhere from $600 to over $2,000 a year. Over a decade of retirement, that is real money. Money that was never legally the government's to take. And here's the part that stings. The IRS is not going to send a letter that says, hey, you overpaid, here's a refund. You have to catch it. You have to file it correctly. And in many cases, you have up to 3 years to file an amended return and get back what you overpaid. That's a real window. Most people never open it. The mistake most seniors make is assuming taxes at 65 work the same way they did at 45. They don't. The deductions are different. The thresholds are different. The credits are different. The rules around Social Security are different. Qualifying and claiming are not the same thing. Here's your practical move. If you file your own return, get a copy of last year's and go line by line. Additional standard deduction for age, taxable Social Security calculation, credit for the elderly. If you use a preparer, ask them plainly, did you apply the additional standard deduction for age? Did you check whether the credit for the elderly applies? Did we run the Social Security taxability formula this year? And if there's any doubt, the IRS runs a free program called Tax Counseling for the Elderly, and AARP runs a related free service called Tax Aid. Both are staffed by volunteers trained specifically on senior tax rules. Now that you know all five, let's talk about exactly what to do this week. So let's put this together. 5 bills, 1 afternoon of phone calls, and a real chance to stop the quiet bleeding. Here's your 30-day plan. Week 1, make 2 phone calls. Call your county assessor's office and ask, by name, about every senior property tax exemption, freeze, deferral, and rebate you may qualify for, and get the deadlines in writing. Then call your gas or electric utility and ask about LIHEAP, senior discount rates, percentage of income plans, and shut-off protections. 2 calls. maybe 40 minutes, potentially thousands of dollars a year. Week 2, handle the phone, the internet, and the medical side. Call your phone or internet carrier and ask about Lifeline and any senior or low-income plan available on your account. Then pull out any medical bill from the last 12 months that you paid without questioning. Request an itemized statement. Compare it against your Medicare summary notice. And if your income is modest, call your state Medicaid office and ask whether you qualify for a Medicare savings program. If the answer is yes, a whole category of bills stops being yours. Week 3, walk into your bank. Ask to be moved into a senior or no-fee checking account. Confirm your Social Security is set up as direct deposit and flagged as a federal benefit. Get a written list of every fee currently being charged. If your bank won't budge, a local credit union usually will. Week 4, look at your taxes. Pull last year's return. Check the additional standard deduction for age. Check how much of your Social Security was reported as taxable. Check whether the credit for the elderly was even considered. If any of that looks off, remember, you generally have up to 3 years to file an amended return and recover what you overpaid. And if you want free, trained help, look up tax counseling for the elderly or AARP tax aid in your area. That's the plan. 4 weeks, a handful of phone calls, a few forms, and a very different set of bills going forward. Now here's the final reframe, and I want you to sit with this one. None of what we talked about today is a loophole. None of it is a trick. None of it is something you have to feel guilty about claiming. These are exemptions, credits, protections, and programs that were written into law specifically for people in your stage of life. They exist because society decided, at some point, that after decades of paying in, seniors on a fixed income deserve a lower bill. The law already agrees with you. The only thing missing is the paperwork. The people who get this money are usually just the people who knew the form existed. So if this video helped you see even one bill differently, do 2 things. Share it with someone over 65 who might still be paying something they don't owe, a parent, a neighbor, a friend from church, and save it because you're going to want to come back to that checklist. One honest closing note. I am not your attorney, your accountant, or your financial advisor. Rules vary by state, by county, by income, and by year. Everything in this video is general education, not personal advice. Before you make a big move, confirm the current rules with your county office, your state agency, the IRS, or a qualified professional in your area. But please, make the calls, file the forms, ask the questions, because nobody is going to call and tell you. The money is yours. Go get it back.